Welcome to part 2 of learning how to trade on a margin account. So if you guys missed part 1, I strongly encourage you to check that one out. The link will be in the pinned comment and inside the description, because in that video, we talked about all the different definitions of excess liquidity, margin maintenance, buying power, etc. Because what we're going to do in this video, we are going to place our first naked put, and we're going to see what happens to some of these numbers. And if you don't know what these numbers mean or how these numbers are calculated, it might be a bit difficult to follow. I will try my hardest to catch everyone up if you don't want to watch the first part. But again, I strongly recommend that you do. So just to be clear, this is on a demo account, no open trades. And the main reason for this is on my live account, I've got a number of trades. So all these numbers are moving every single day, every single second. And I wanted to have a clean account to show you what happens after you start placing trades inside a margin account. So in this part, we'll go through selling a naked put, and then in the final part we will then open a naked call on a different underlying, and then you can see what happens as time goes on with the different situations. So the key thing really to understand is our total cash on the account is $6,331K. Our buying power is just over $25K, and that is our available funds times by 4, as we talked through in the last video. Our margin maintenance at the moment is 0 because we have no open trades, and margin maintenance looks at the amount of margin that is needed to hold open positions. And our excess liquidity, again, is 6.3K, and that is our equity to loan value minus our margin maintenance. So again, check out the previous video because I go into it in a lot more detail. But one of the key things to realize is when you trade on margin is excess liquidity or X liquidity. Because if this number drops to 0, IBKR, or that's the broker that I'm using, or any other broker that you guys are using, will basically start liquidating your positions and start making you into a margin call. So it's very important before you place trades to understand how your excess liquidity changes, or in this example, goes down when you open new position. So therefore you're not over leveraged and you've got a buffer in case trades start to go against you. So what we're going to do, we're going to open a trade. So we're going to hit on trade, and we're going to do Square. And the reason why I'm doing Square is because it's a $64 stock, and anyone that knows that if you are trading on a cash account, you need to put up 100% of the funds of the strike price that you select. And I wanted to, so if I was to sell the $64 or $65 strike, for example, I would need $6,500, and we've got $6,300, so it won't allow me to place this trade. Now, I wouldn't do an at the money put strike, but even if I was to do the $50 strike, I would need $5,000 to place the trade, which is the majority of the margin that I actually have available to trade. So that would be pretty silly to do on a cash account. Now, to trade this on a margin account is slightly different because you don't need to put up the full 100% of the collateral in case you get assigned the shares at $50, $40, whatever strike that you pick. And this is one of the advantages of margin trading, because you can put more positions on or more size on, but also keeping into account of how big your positions are. So we're going to trade a one contract or sell a put option for one contract, and I want to show you the numbers and where you can see what the numbers look like before you enter the trade. You find the stop price, so it's obviously square or block as it's called. You click on options and spreads, and what that does is bring up the option chain. So we are live in the market, obviously, otherwise you can't trade options outside of the market. And what I like to do, for those who've been watching my content for some time, I like to trade options on the monthly cycle, anywhere between 45 to 60 days out. So the first monthly cycle when this video is taken is June the 16th. And I know it's a monthly cycle because I don't have these W's on the side here, which are weekly options. So you have the May 19th monthly option, but there's only 25 days left. And I look to roll any open positions I have around 21 days. So I wouldn't be opening one just for 4 days to roll it again. So therefore I've selected June the 16th. Usual option chain, you've got the puts on the right, calls on the left, going down in price or strike, going up, and then going down, we've got the price going up. So we want to sell a put option, so we want to be looking at the right hand side. And for this tutorial video, I suppose, what we're going to do is we're going to look to sell the 12 delta. I like to trade anywhere between the 12 and the 20 delta, so you can go to 55, but again, it has got earnings coming up shortly, I think, within this cycle, so that's something to consider. So we're going to go for the 12 delta, and what that basically means is that there's a 12% chance that at expiration, block or square will be below $50 at the day of expiration. So if we look to sell this option by clicking on the bid, you can see here we've got fairly tight liquid markets. The mid is 108 from 107 to 110, so it's a couple of cents wide on either end, which is what you want to get better fills and all those kind of good things. And again, if we had a cash account, we would need to put down $5,000 into this position. So if we click on the order button, you can see here that we are looking to generate a credit here of $107. Now, what I'm going to do is I'm going to select a market. I wouldn't do this on my live account, but on demo accounts, it does take a while to get filled on demo accounts. So therefore, I'm going to do the market. Now, the key thing we have to do before you slide to submit this order, we want to be hitting the preview section. And the preview section will show you what your current equity to loan is, what your initial margin is, and what your margin maintenance is. Currently, how would these numbers be affected if you were to place this trade and get filled, and what these numbers would look like post trade. So if we walk through what these mean, because this is very important to understand. So the first one is your equity to loan value, which again is your cash plus any stock value. So our current cash value is the amount we have in our account, which is $6,311. And if we were to get filled at $109, therefore we are taking in $109 of credit. Therefore, our equity would go up by $109 to $6,420. Now, the next piece then is initial margin. So initial margin is the value or margin that's needed to open trade. Now, to open this trade, again, on a cash account would be around $5,000, but you only need $2,137, which is what, about 40-ish%, I would say. So therefore, we currently have no open positions. So therefore, our initial margin currently is 0, and then we'll jump up to 2,137. So if we think about our buying power for a second, our buying power is basically our equity to loan value minus our initial margin times by 4. So if we look at this, that's about 4K times 4. So I'm guessing it's around, it will drop by 16 to 18K. Can't work out the maths in terms of my head, but I would imagine our buying power would reduce, obviously, as we're placing new position. And maintenance margin is the amount of margin you need to continue holding this trade. Now, as you'd imagine, on a cash account or cash secured put, this would be $5,000. But you can see here, again, we only need $785. So $785 divided by 5,000, we only need 15.7% to hold this position inside our portfolio, which is great. And again, you could probably do 2 contracts, all of these different things, but that's not what we want to do. Now, one thing it doesn't show you here on IBKR, which I think is a critical factor, is your excess liquidity. But we know the calculation from the previous video of what our excess liquidity is. So that is our equity to loan minus our margin maintenance. So if we have a look at it, it's 6,420 minus 785. If I can even type in the numbers. Therefore, we're expecting our excess liquidity, again, depending on when we get billed, commissions, all of these things, to drop from 6.31 to around 5.63. So again, what I've done is just making sure that we are selling the June 16, 2023 $50 put for, around $100. I'm going to slide to sell this at market. Hopefully we get filled straight away, which we do. Now, let's go back to our portfolio and have a look to see what has actually happened over here. So you can see the square position on here. You can see we're down $3.51 for the day, which is spread and fills and all that type of stuff. So you don't need to worry about that for now. But what we can see is, as we did before, is our X liquidity, we estimated it would drop to 5.636, which you can see here is pretty much thereabouts. So we can see we've dropped from 6.31 to 5.63. And again, we said our buying power will drop between 16 to 18K, and you can see that it's dropped to from 25.24 to 17.12. And again, our total cash has increased because we generated around $100 of credit from this particular trade. Those are the numbers that you can see. And lastly also is our margin maintenance, which is slightly higher actually than I think what it was. I can't remember what it was. I think it might have been around $600, $500, but it's $787.90, which again is fine. But again, the key thing is you don't need to worry about the margin maintenance to a certain extent. You don't need to worry about your equity to loan and your cash value. The key figure is watching your excess liquidity. If that starts dropping to $5, $4, $3, $2, $1,000, then we know that we can put on less positions and we might potentially be coming into a margin call. So we might want to close out this position, roll this position to a better strike, whatever it is that we want to do to maintain it. And that's why excess liquidity on your main screen is very important, to make sure that you have enough buffer in there for this particular position. So I really hope that kind of makes sense to you guys on that is how you sell a naked put option using margin, how the numbers change and what you need to look for when placing this position. So I really hope you've enjoyed this video. The next video or the final part is us selling a naked call on different underlying to see how that works. So depending on when you're watching this, that video will either be on the screen or there'll be another video around one of my options trading strategies. And I shall see you guys in the next one.